Welcome back to my channel where we dive into all things investing for financial freedom. In my last video, we looked at investing in AI stocks and NVIDIA specifically. Stock picking requires constant research, analysis, and the ability to stay cool-headed during market swings. What if there was a way to capture the growth of leading companies across the globe, without the stress and hassle? Today, I want to dive into the world of index funds, your one-stop shop for a diversified and low-maintenance investment approach. We'll explore how index funds work, their advantages over stock picking and actively managed funds, and explore if there's a case to be made for using index funds to gain access to technology megacaps. Okay, let's get started. First off, let's talk about index funds. An index fund is a type of mutual fund or ETF, designed to follow the performance of a specific market index, like the S&P 500 or the FTSE 100. These funds aim to replicate the index's performance, by holding pretty much the same stocks, in the same proportions. This means you're essentially investing in the entire market or sector, rather than trying to cherry-pick winners. In contrast, actively managed funds are investment vehicles where a fund manager or a team of managers make decisions about how to allocate the fund's capital. They aim to outperform the market by selecting investments they believe will increase in value more than the market average. Now, onto stock picking. While the idea of picking the next big winner might seem appealing, it comes with its own set of challenges. Very few people have the skills, patience, temperament, and discipline of investing legends like Warren Buffett and Peter Lynch. It takes a lot of research, time, and emotional control to pick stocks successfully. When you're stock picking, you're always wondering if you've chosen the right stocks, missed out on others, or how much of each stock you should hold. Consider the recent volatility of individual stocks like Apple. Picture putting all your investment eggs in the Apple basket, only to see its one-year performance increase by only 13%, while NVIDIA surges by 273% and Supermicro's by 1,056%. Here's where index funds come in. They come in all shapes and sizes, catering to different investment goals and preferences. Global index funds, such as the Vanguard FTSE Global All Cap Index, offer exposure to a broad range of companies from around the world, across different sectors and market capitalizations. Country-specific index funds, like the Vanguard US Index, focus on a specific country's stock market. Cap-size index funds, such as the Vanguard Global Small Cap, allow investors to target companies within a specific market capitalization range. Non-market cap-driven index funds, such as the Invesco FTSE RAFI Global 3000 Index, use other factors like dividends, cash flows, sales, and book value to select holdings. Sector-specific index funds, like the Legal and General Global Technology Index or the Legal and General Global Health and Pharmaceuticals Index, concentrate on a particular sector or industry. Now, let's look at the pros and cons of investing in index funds. Oh, if you're enjoying this video, hit the like button and subscribe for more investing content. Okay, so on to the top 5 pros for index funds in comparison to active funds and stock picking. In contrast to stock picking, index funds provide exposure to a broad range of companies, sectors, and regions, automatically ensuring that you own a piece of the winners in their respective categories. Through diversification across a broad range of assets, index funds mitigate the impact of any individual company's poor performance on your overall portfolio. They also typically have lower expense ratios compared to actively managed funds, leading to lower overall costs for investors. Over a period of 10 to 20 years, even small discrepancies will have a significant impact on the performance on your portfolio. Many studies have shown that most actively managed funds underperform their benchmark index over time. SPIVA, or S&P Indices versus Active Scorecard, compares actively managed funds for a range of regions against their benchmarks. The SPIVA data confirms this for US funds. Only 40% outperform their index over 1 year, and this is the best result, but 80 to 90% underperform in the long run. You see a similar and consistent pattern for global funds. Index funds, like the S&P 500, periodically update their constituents and undergo regular reviews and adjustments, automatically removing underperformers while adding emerging stars. For example, the S&P 500 recently added Supermicro, whose stock price has outperformed even NVIDIA, ensuring you're always invested in the leading US stocks. Index funds offer a simple, hands-off approach to investing. They automatically diversify your portfolio across a broad range of companies, without the need for constant research and the emotional pitfalls of picking individual stocks. This can help you avoid the FOMO syndrome that can lead to chasing hot trends or the flavor of the month. Now let's explore the top 5 cons for index funds in comparison to active funds and stock picking. Diversification is a double-edged sword. It lowers risk, but may also limit returns compared to successfully picking winning stocks. But then again, diversification reduces concentration risk, which helps avoid placing all your eggs in one basket. Index funds track the market, so you won't outperform the market. In some cases, you may underperform, though only slightly, due to tracking error or cash drag. As index funds are subject to the overall performance of the market, they offer little downside protection, and may experience significant drawdowns during market downturns. Most index funds will not perfectly track their benchmark index due to factors like fees, cash drag, or optimization techniques, leading to potential discrepancies in performance. A good example is the Vanguard Global All Cap, which holds only 7,000 funds, as opposed to the underlying index with 10,000 funds. I say, only 7,000, but clearly, there's a point of diminishing returns of tracking the index precisely, and the increasing costs to do so. Index funds follow a predetermined index, leaving no room for investor discretion in selecting specific stocks or sectors. They also lack the potential benefits of active management, such as tactical adjustments, based on market conditions or anticipating trends. While this limits the ability to tailor portfolios to specific preferences, it can serve as a safeguard against biases, blind spots, and emotional decision-making. Consider the Legal & General Global Technology Index Fund, tracking the FTSE World Technology Index. This fund invests in large-cap global technology companies, including mega-caps like Apple, Microsoft, and Google, as well as semiconductor firms like AMD, NVIDIA, and Taiwan Semiconductor. Historically, it has outperformed the S&P 500 and Nasdaq over a range of time horizons. While stock picking can be tempting in the current AI frenzy, it's essential to adopt a broader diversification strategy to capture technology winners and leaders across all technology themes and geographies. For US investors, alternatives like the Vanguard Information Technology ETF, VGT, or the iShares Global Tech ETF, IXN, provide exposure to similar tech giants. So, how can we integrate the L&G Global Tech Fund into a portfolio? I'm a big fan of the core satellite approach, which combines diversified core index funds with the growth potential of thematic investments. Here are some options to consider. If you're in your 20s or early 30s, you might look at a higher risk, 70-20-10 portfolio. The 20 being your satellite, comprising 90% equities and 10% bonds. Your core could be the Vanguard Global All Cap Fund, providing broad market exposure, starting at 70% of your portfolio. This is your base. Instead of a significant bond allocation, allocate 10% to Vanguard Global Bond and Vanguard Global Short-Term Bond Index funds combined. This leaves 20% for satellite funds. For younger investors, allocating the full 20% to the L&G Global Tech Fund is an option. Alternatively, split 10% to tech and 10% to Vanguard Global Small Cap. You could also consider exploring healthcare, emerging markets, or even individual stocks in the satellite portion. But limit your stock exposure to 2 to 5% of the total portfolio, with no individual stock exceeding 2%. The satellite portion aims to contain risks associated with growth and higher risk investments, while safeguarding your core investments. As you age, you might want to reduce the satellite allocation towards a more conservative 60-30-10 portfolio, comprising 70% equities and 30% bonds. Consider allocating 60% to Vanguard Global All Cap, 30% split between 2 Vanguard bond funds, and the remaining 10% to satellite investments like the L&G Global Tech Fund. Alternatively, you could include other funds like small cap and healthcare in the satellite portion. You also want to scale back stock holdings to no more than 2% of your portfolio. Rebalancing your portfolio as you age helps minimize the impact of growth and higher risk investments. After benefiting from the investment growth in the prior 10 to 20 years, transitioning to a lower risk portfolio locks in gains, while reducing exposure to riskier sectors and asset classes. So, back to our original question. What's the best way to gain access to the technology megacaps? Index funds offer a compelling choice for many investors, providing broad exposure, lower fees, automatic rebalancing, and potential long-term growth. While stock picking can yield higher returns for some skilled investors, the risks associated with it make index funds a better and simpler solution for building a solid, diversified portfolio. What about actively managed funds? Spiva data indicate these consistently underperform their benchmarks, reinforcing the value of index funds. The core satellite portfolio, primarily comprising index funds, offers a balanced and diversified strategy, with the flexibility to capitalize on growth areas like technology and AI. Remember, the best strategy aligns with your financial needs, risk profile, and retirement goals. For personalized guidance, consult a financial advisor. If you enjoyed the video, don't forget to like, share, and subscribe for more content. Thanks for watching, and I'll see you in the next one.